$10, 500 in annual dividend income from Corning is about to disappear, and the tariff timeline means your cut is already locked in for Q2 2025. If you hold Corning Inc. GLW in a dividend ETF or own it directly, this is critical. Most investors believe large-cap industrials like Corning are insulated from tariff shocks because they're diversified and too big to fail. That belief is about to cost you thousands in foregone income. And we're about to show you the exact dollar amount and timeline. Here's the reality. Corning derives 45–50% of its revenue from China-exposed supply chains, smartphone glass, display substrates, semiconductor inputs. A 25% tariff on inputs or finished goods could reduce operating margins by 200–400 basis points in 2025. That margin collapse directly triggers dividend cuts. The data is already in Corning's 10-K filings. The tariff effective dates are public. Wall Street is pricing this in slower than it should, which means your dividend cut is already mathematically locked in, even if the official announcement comes later. Let's put the delta in actual dollars because this is where it gets personal. You own a $300,000 position in dividend-paying industrials yielding 3.5%. That's $10, 500 in annual income today. A 30% dividend cut, conservative based on historical precedent when payout ratios fall below 1.3 times, costs you $3, 150 per year, over 5 years to retirement. That's $15, 750 in foregone income, plus reinvestment drag and portfolio rebalancing fees. That's real money. If Corning represents 10–15% of your industrial holdings, you're exposed to this exact scenario right now. But here's what most investors miss: the timing. Why does this matter right now? Because Q1 2025 earnings season is live. Corning reports earnings within the next 2 to 3 weeks. That call will include forward guidance on tariff exposure and margin pressure. Once that lands, analysts will immediately recalculate payout ratios. If coverage falls below 1.3 times the historical sustainable threshold, the dividend cut signal triggers instantly. The market reprices in minutes. You'll be reactive instead of prepared. And that's when your position starts to underperform. Let's look at the exact risk signal hiding in Corning's latest 10-K filing. The company discloses that tariffs on glass inputs, semiconductor substrates, and finished smartphone components represent a material risk to operating margins. Here's the damaging part. The company also notes that pricing power is limited in highly competitive markets, meaning Corning cannot simply pass tariff costs to customers like Apple or Samsung. They absorb the hit. Margin compression follows. Dividend coverage declines. The math is non-negotiable. Meanwhile, and this is crucial, competitors benefit. Saint-Gobain and Asahi Glass both have lower China exposure in their core segments. They'll lose less margin. Their dividend yields may hold or even improve as market share rotation favors them. Your Corning position gets hammered while peers hold steady. That's the performance drag nobody's talking about. Now let's look at the holdings exposure. Corning is a material position in VIG Vanguard Dividend Appreciation ETF at approximately 1.2% as of Q4 2024, and SDY Schroders U.S. Dividend ETF at similar weighting. For $100,000 VIG holding, that's $200 in direct Corning exposure. If Corning's dividend gets cut 30%, your VIG yield compresses by approximately 4 basis points. Doesn't sound like much until you multiply that across the fund's $280+ billion in assets and your personal time horizon to retirement. That compounds into real opportunity cost. Here's the deeper layer. Corning's payout ratio has been climbing. In the last 4 quarterly earnings reports, the ratio trended from 1.25 times toward 1.38 times. That's already approaching danger territory. A 200 basis point margin hit from tariffs pushes it above 1.5 times, unsustainable. The dividend cut becomes inevitable, not speculative. The actionable move starts tonight. Open your latest ETF statement or brokerage statement. Search for GLW Corning ticker. If Corning appears, note the position size down to the dollar. Then pull Corning's most recent 10-K from the SEC Edgar database and search for tariff, China, and margin. Read those sections carefully. Look for the payout ratio trend in the last 4 quarterly earnings reports. If it's climbing toward 1.4 times or above, dividend cut risk is real and imminent. Finally, set a calendar alert for Corning's Q1 2025 earnings call date, usually the first or second week of February. Listen to the guidance on margins and China tariff impacts before the analyst consensus shifts and before the market reprices. Markets reward the patient and the prepared.